All right, and welcome back for the episode of Carnivore Trades. Today is Sunday, December 18th, 2022. If you've not done so already, give the video a thumbs up, like, comment, subscribe to the channel. Come find me on carnivoretrades.com for swing trading alerts and analysis. Anyways, I want to talk today about zero DTE options because they are changing the game, whether we like it or not. There are some very fundamental changes going on in this market, and this is something that needs to be talked about for sure. And why I don't like this and why it could also be problematic in the future. So what is zero DTE? Zero DTE just refers to options that have less than 1 day till expiry. So previously, we're just looking at the spiders here, but previously there used to be expiries on just Fridays. So it would be monthly options X. You see the red lines there. Those represent the monthly OPEX. It used to just be Fridays years ago. Then they changed it to Monday, Wednesday, Friday. Just the spiders were doing that. And then they added the Qs in. And recently on November 14th, so we're looking back to about a month ago, they changed it to every day. Every day for the spiders and the Qs. So we have an OPEX every single day in the market, and it's almost like at this point, it's almost like there's every day is its own kind of like macro business cycle. It's actually kind of insane, and how this market has been trading here, and why this matters. If for those of you who are not really familiar with the options market or expiry, basically the market makers issue premium via the options, and it's in their interest to have those premium, those options expire worthless. So if I issue a spider's call at 400, I want that to, close below 400. That way I don't have to pay it out. If you're a market maker, you might have, 50 million in premium expiring at this strike, but you have these computer programs that tell you, hey, it's only going to cost us 25 million to basically short the stock to keep it down, just for the day or just for a couple of days, or vice versa. They might be buying it to keep it long if they have puts sold, vice versa. However it works, but you might determine like, okay, it's going to cost us 25 million or whatever to do this, but we get to pocket the other 25 million in premium. So it makes sense to do that temporarily. The problem with this is when it's happening every single day, it's completely bastardizing price discovery. So and we could just look here, all year long, pretty good price action. As far as consistent movements here, we can see the trend lines here, up, down. There's no real, it's pretty good volatility, right? And then we get into November 14th exactly, this is the day that they started doing that. And you can see since then, I think you can visualize it a little bit better on the futures, but just take a look here. We've been basically outside of the last week or so. Eventually, this can't go on forever, right? But eventually, outside of the last week or so, we've just been stuck between 39.50 and 4,000. It's taken major volatility events, Powell speaking, CPI, Powell speaking again, to get us through this level. And really, you could make a base case. I mean, if we rallied back up here, we could get right back into this channel. Why is this happening? Well, retail specifically is going nuts with these options. And I think there's institutional involvement as well. I think my suspicion is that somebody wrote an algo that does this, because this is coming up pretty much on a daily basis here. Let's flip over. I'm going to show you something by spot gamma here. How much short dated option volume has increased. While zero DTE volumes for SPX were typically around 30% of total SPX volume to start 2022, they have increased recently to 50%. 50% of total SPX volume. So they haven't increased by 50%. 50% of options that are traded are zero DTE. Also, Goldman came out with a report a little while ago that suggests options with less than 24 hours expiration now represent 44% of index trading volume. This is, you can see the graphs here, how much they've increased here over the last year. And this one actually is going back to 2012 or 2011. This is pretty astronomical. And that's why in my opinion, part of the reason why we've been staying in this range, because you have people essentially gambling on 0 day till expiry, buying 40, 50, or maybe buying 39.25 calls on the downside. Market makers are saying, we're not going to let that happen. Just pin you right to this price range and pocket that premium. So market makers have been making a killing outside of these couple of outlier days where we had, obviously Powell speaking. And in the CPI, they got blown out pretty hard, especially at the end of the week. They definitely got blown out really hard. But the rest of the month, they made a lot of money here. And this has been a growing problem. It's really been kind of building up all year long. And now with the options being having a daily expiry as opposed to just 3 times a week, it's really gotten out of hand here. We saw the gamma squeeze in Jackson Hole. That was pretty bad. The gamma squeeze right before they did the 0 DTs every day. I mean, we were up 7% or something like that on the NASDAQ. That's guys, that's not normal. I don't know if you guys have been trading, how long some of you guys have been trading for, but for those of you who have been trading less than a few years, that's not even close to normal. To see this multiple times throughout the year, by the way, we've had these big moves here. And a lot of it has been short-term gamma. Why is this a problem? Well, like I said already, it bastardizes price discovery, right? So, take a look here. So we had this big surge on Powell a few weeks ago, and then what happened? They pushed us right back into this range. So it's like I said, it's almost as if the macro business cycle is like, it's almost like there's just one day. Each day is its own macro business cycle now with how it's trading, because there's no follow through. You'd think that when we blow through this range like that with good volume there, take a look, heavy volume on the ES, heavy volume on the spiders as well, even heavier volume on the spiders. That should be a breakout. There should be follow through to that. And then again, they tried to do it again, and the bears came in and whacked it back down. I think this was more than just market makers, but the point is, there's a lot on the line every single day now, and the amount of volume that's being traded. It used to be where the Monday, Wednesday, Friday expiry weren't that big of a deal because there wasn't a lot of premium expiring because there wasn't that many people trading it. The monthly OPEX were they would dwarf the size of the Monday, Wednesday, Friday, and it still does. The monthly OPEX definitely still dwarfs it, but it's getting increasingly. We're seeing increasingly more volume being traded on these short dated expiries, these Tuesday, Wednesday, Thursday expiries, and it's causing a lot of problems out here. I can in fact show you, just so you guys can visualize it here. Let's take a look at some of the active chains. This is from December 9th. So this is the most active chains on this particular day. 0, 0, 0, 0, 0, 3, 0, 0, 3. They're all 0 day till expiry. Take a look here. 0 days, all of them 0 days, except for a couple that are 3 days till expiry. Take a look at this one. These are all just 4, 5 days away. This is the second page of that. So you can see and you can visualize the amount of increasing in options volume here that we have on short dated and 0 DTE expiry. Now you might say, well, who really cares? Like, let the market makers, if the market makers are making money or losing money, who really cares? You should, because this is very reminiscent, and this is just my opinion here. You guys let me know what you think. I think that this is going to be the next thing that causes. You guys remember 2018? For those of you who were trading back then, look at the VIX here. You guys remember Volmageddon, where we blew up? In like 2 weeks, we went from 12 to 50 on the VIX. I think there's something like that kind of bubbling underneath the surface here. If we get blowout that's bad enough, and market makers are forced to hedge repeatedly, and not just for 0 DTs, but the next DTE. So one day till expiry 2, and then the monthly, and so on and so forth. If we get gamma squeezed hard enough, there could be a serious meltdown here. We could have kind of like a Black Monday or some type of a crash scenario, a flash crash, something of that nature. I think that's what's brewing here. And for the life of me, I don't know why CBOE would allow this to happen. We already have expiry Monday, Wednesday, Friday on the Qs and the SPY. Why do we need it every single day? I think this is just a ticking time bomb waiting to happen, personally. But right now, this is what we're in. And not only is it doing this, but it's also screwing up the VIX. So you guys, everybody's been talking about it all year long. Why isn't the VIX higher? Why isn't the VIX doing this? The VIX is formulated based off of a lot, it's short dated, medium dated, and long-term dated, it's the calculations. With the increase in the short dated volatility, it's skewing the VIX. It's also skewing the put call ratio. If you look at previously, just in the last week or so, we can see the put call ratio put call composite surged to a level that's really never been seen before. And this was going into the CPI date. So, for what it's worth, there was at least a little bit of, reasoning behind it. But it's not like we were at, if we were at 52-week lows and we saw a surge like that, it would be like, okay, well, there's at least something to it. And I would take that as a huge contrarian buy signal. But this was going into the CPI date. What happened? We gapped up and we actually sold off. So if you looked at the put call composite the day before and you said, well, okay, well, basically everybody's betting on downside. Normally, right, that's the contrarian play. You went all in long and then you got roasted the next 3 days. So it's even screwing up the put call composite. It's screwing up the VIX. And I think it's just a matter of time before somebody blows up. Somebody that is too big to blow up blows up, and we have more problems. And with the Fed doing quantitative tightening and inflation as high as it is, they're not likely to come to the rescue, or it's going to be harder for them to come to the rescue if this does happen. So anyways, let me know in the comments what you guys think. I think it's a ticking time bomb waiting to happen. And I don't see really any sort of, I think that the downside potentially way outweighs the upside here. But anyways, you guys let me know what you think. You guys take care. Come find me at carnivoretrades.com. I'll talk to you guys all tomorrow.